Hello, I'm Steve Stafford. Thank you for joining me for this episode of All Business is Personal, which is the second of our two-part episode on pre-sale planning opportunities for business owners who are planning to sell their business in the near future. In our last video, we focused on the importance of proactive due diligence and steps you can take before starting the sale process. In this video, we are going to look at some of the pre-sale tax planning opportunities that business owners may be able to utilize to save on California income taxes, federal income taxes, or estate and gift taxes if they start planning a few years in advance. So, what are some of the tax planning opportunities business owners should consider? First, if they're willing to give up the nice weather and move their family out of California, it is possible for a seller to change their state of residency and avoid California income tax on part, or in some cases all, of the sale proceeds. Given California's top income tax rate of 14.4% and a company value that is large enough, this can result in significant tax savings. But let me be clear, this is much more involved than just buying or renting a home in Nevada and staying outside of California for more than 6 months and a day each year. Not only does California evaluate a litany of factors to consider residency, it also considers a person's domicile, the state that a person ultimately intends to return to, and which state the person has the closest connection to. Plus, be aware that California has at least 4 years to audit your tax returns if you report your income accurately, and even longer if you underreport your income or don't even file a return. Now let's look at some other tax planning opportunities that exist whether you stay in California or not. For example, for those business owners that want to save on income taxes, benefit their favorite charitable organization, and reduce their taxable estate, charitable planning opportunities such as a charitable remainder trust can be an attractive option. Business owners can also save on estate taxes by shifting value to irrevocable trusts for the benefit of their family members in advance of a sale. Given the current top estate and gift tax rate of 40%, a transfer of ownership interest in a successful and appreciating business to an irrevocable trust at a lower pre-sale value can result in powerful estate tax savings. Another opportunity to look at is whether the selling entity itself can be restructured in advance of a sale. Let me share 2 examples of how pre-sale restructuring has yielded significant tax savings. First, we once worked with the shareholders of a C corporation that was about to explode in value over a 3 to 5 year period, but which didn't qualify for the qualified small business stock capital gains exclusion. We were able to transfer the C corporation's assets and operations into a multi-class LLC that gave the C corporation a preference as to its appraised value and shifted the future growth to the individual shareholders, so the post-transfer gains from the eventual sale were only subject to 1 level of tax. In another instance, my firm incorporated a successful LLC into a C corporation after the LLC was able to benefit from taking the losses as a partnership and then grow its value significantly. In order to get the capital gains exclusion as qualified small business stock under Code Section 1202, which, as I explained in video number 2 in this series, allows certain C corporations to exclude capital gains up to the greater of $10 million or 10 times basis. Finally, another opportunity to consider is whether the deal proposed by the buyer can be restructured. For example, we have had the opportunity to successfully restructure C corporation asset sales so that the shareholder was able to sell their own personal goodwill separately and get capital gains treatment, leaving only the C corporation's assets subject to the 2 levels of tax. In conclusion, if you plan to sell your business, you should consider whether there are any advanced tax planning opportunities to reduce your tax liabilities. After all, you built your business, and you should ensure that the success of your business accrues to the benefit of you, your family, your employees, or your favorite charity, and not to the taxing authorities. Thanks for watching. I hope you join me for our next installment, which will focus on the process of selling your business. As a reminder, this video is for educational and information purposes only and should not be taken as legal or tax advice. Thank you.